All right, hello guys, and glad to have you on board again today. We totally missed on the weekly update, so sorry about this one. I just totally forgot, and now that we're already in Wednesday, so I thought it was worth it to kind of blend in with both of time frames. So we're going to do a quick review of things that I wish I could have said into the weekly update, and we're going to zoom into the shorter time frames to see halfway through the week how much progress we've made in either direction. So basically, the only thing that I wish I would said on the weekly update is there's nothing happening in the crypto market. Still very, very limited volatility. Of course, this is the calm before the storm. Everyone agrees about that, but there's still a lot of speculative behavior in here, so I'll pass on these ones for now on the longer time frames. When it is to the stock market instead, S&P 500 is showing some very interesting signals on the weekly candle. Thing is, it's not closed yet. So this is something that's going to have to be assessed on a shorter time frame, speculative perspective to see if there are more chances to validate or not. We'll zoom in, of course, in this video, but this is what I would have said in the weekly update. So if this signal is consistently showing up, this is a trend follow signal, meaning that we're going to build a major high point in a trend. So these shaded blue boxes means that they must occur in trending context, otherwise don't even pay attention to this. So they're definitely in a trending context in here. We're still trading above rising moving averages. We're terminating a cycle, so this would be fully consistent with what I'm looking for, or at least what I decided to trade and therefore risk manage, which would be finishing that wave one extended, which is no more than just a narrative in which the Fed is going to do anything it can to calm down inflation, but inflation is still there and it's not going to stop. The thing is that we might reduce eventually at some point, but the thing is that we've diluted the money supply, so prices can only go up. But in that perspective, this is not the upside potential that we had on the early stages post-COVID rallies and stuff like that. Wave one extended, extrapolate their trending behaviors in the early stages, and then it looks more like a bullish range at the end of the game, which means that there are some ups and down swings that you can both trade, but the thing is that there's more upside potential than downside potential. So I could be wrong with that. Like I said, we might be nearing the end of the world and the full crash of 2022 or whatever. Like I said, risk manage your probabilities, make a choice and stand for it. Just don't be a switcher. Don't be among the guys who finally turn out to be end of the world territory when we're already back on supports. Okay? So that's really the way you have to deal with it. If that's the case, then this is definitely the type of signals that I think are consistent. We're not just oversold, we're overloaded, meaning that there's just so much bearishness as we're still trading above rising moving averages. So, like I said, it is consistent to the thing that I believe are the most probable. It is a pullback, and a pullback is generally when people fear the fuck out of a bear market, when actually turns out it's not the case. They get wrong-footed and they get pulled back right back to all-time highs, not necessarily in a bull market, just because it wasn't bear. It's just it's just what this is, okay? So in a shorter time frame perspective, in order to figure out those probabilities, I would like to use some more advanced techniques and basically third range boundary maturity alignment to figure out how much bearish flow probability there is. And to be honest, there's none at all. When I have a look at the probability of this to be a massive bottom, it checks all the boxes. I can't tell you everything about expert level stuff, otherwise you guys would use it without knowing anything about it. But to do the TLDR, I'm looking at third range boundary alignment. In here, the third range boundaries are aligned, and I'm looking at the relative strength of their signalings as they pass on. This one, the last one, which matters the most, is a delayed third range boundary with bullish signals on the trend channel. This is basically as bullish as fuck. So sorry about the rude words, but this is what it is. The last third range boundary is crazy bullish. This one says that the bears are getting the hell out of it as fast as possible. This is short covering XXL. But the thing is that the previous two third range boundary were squeezed. This one was squeezed, this one as well. So in that perspective, these two were more bearishly tainted. So I would say, even though this one is the top-notch level of bullishness, And it is the most important one in this thing because that's the third one, adding to the fact that they are aligned, which is another increasing factor of reversal potential. I would still say this is not going to be a calm path to the upside. This level might still be eventually be retested as a support, even though I don't necessarily think it's a granted stuff, but I think we could go back there. If we do, then this is going to be a very interesting buying entry to me to reinforce my existing positions, as I can reduce my stop loss and finally put them below those levels. I have the reversal pattern, so I know for sure now that if it goes down making new lows, I'm getting the fuck out of here. Okay, so that's really what this is all about. I'm going to start invalidating my scenarios if we go back there. Otherwise, I think we have a clear, neat probability of bottom with this third range boundary alignment and a rising delayed third range boundary for this one. Very, very interesting. Still, that also tells me that the area of that squeezed third range boundary is going to be heavily resistant, and that's going to be my target number one for these shorter time frame trades. So TLDR in here, this is expert stuff. Don't try to play this game. I just highlighted all of the areas that you might want to be eventually trading on shorter time frames, only if you know how to do it. Otherwise, stay safe, wait for the weekly chart to confirm the signal, and you'll have what you need to reduce your stop losses, eventually reinforce positions ahead of a potential forthcoming all-time highs. And just like each and every trade, there will be associated risk with that, a stop loss, and so on. Okay, so don't try to forecast the future. Try to be smarter than that. Pick a side, pick a choice, and risk manage the probabilities of being proven wrong. If it ends up for you being proven wrong, take the fucking stop loss and move on. That's really what this is all about. Right now, number one's mistake is to be a switcher. Okay, so that's for the stock market. Lots of interesting things to corroborate that as well. The VIX has been doing the exact reversal pattern, meaning that we broke out of these trend lines, compression triangle, but we failed to break the previous resistance. That's exactly what we've done before by breaking and failing to break the previous support. So we're still dancing in this stupid game, bullish, bearish, swing trades in which we just flush all away the consensus. It's basically now everyone's bearish and the prices will go up, and then everyone will be bullish and the prices will go down. So it's just the same old stupid stuff. Like I said, consistent with range context. The market goes up, so people increase their bullish narratives, and when it does, market goes down and people go bearish again, and the market goes up. So absolute stupid stuff. So volatility remains very high. But my personal opinion is the next target is 19. That is more than enough to get us back to all-time highs, not necessarily in a straight line manner, but volatility should go down. This is my next major target. Of course, invalidation and my opponents will target this area, which would trigger stop loss for my personal strategies. And like I said, I don't know the future. I just know that those who consistently repeat a strategy over time are the ones who make money. Those who gamble or play the switchers are the ones who will inevitably lose over time. That as well is corroborated by the tenure, which I'm paying a lot of attention to in the recent trading sessions, which is basically, I think this is where the true signal is going to come from. Like I've always said, I don't think the Fed is driving the market. I think the market is driving the Fed, and even though they're trying to play politics, they rather like not to gamble against the bond markets. And if that's the case, then like I said, there is a huge problem. We can see that there is 95% expectation of a 75 basis point rate hike when actually the 10-year yield says otherwise. The 10-year yield will send the message. There is still room for both of them to actually occur, but it requires the 10-year yield to keep its current pace, which in my personal opinion is going to be sent as an opposite message. We're trying to accelerate, which means if there is a market top, it's going to happen near, and if we break this trend line, that's going to be the sign for me that the bond market has sent a message to the Fed, and it's going to be up to the Fed to decide. Of course, the Fed will act on the 2nd of November, so don't anticipate too much. I'm really diving down the rabbit hole in here, saying that everyone's wrong about what the Fed is going to do. They all think the Fed is going to knock on the table and destroy everything. I think the Fed is not stupid than that. They're going to just listen to the markets and follow it. If the 10-year yield breaks out of this thing, there's not enough room for a 75 basis point. And if that's not the case, well, then in that perspective, other traders, those who say the Fed's going to pivot, might have it all wrong as well. The Fed is not going to pivot anytime soon. It's just going to change the pace of the monetary policy. This is what I all believed. This is what I believed all along. The 75 basis point rate hike type is not going to last that much because it is very dangerous for the economy. And more importantly, when you touch on the interest rates, the actual effect on the economy are delayed for 6 years to a month. So it takes a long time for these things to process. So as they rise very quickly, they will not get immediate results. So this is absolutely utterly stupid to think that the Fed will stop when when the inflation will be under control. It's not the thing. This is not about pivoting. This is not about pulling straight line 75 basis point and stopping there and after as a flat thing, which is exactly what this thing is anticipating. If you're having a look at the probabilities in the future, the market is anticipating that we go straight up 75 basis point again on the next meeting and the one right after, and then it's going to be 25 and terminated. I disagree entirely with that vision. I personally think that the Fed is going to switch to a 50 basis point per meeting type of rate hike, which is certainly not going to change anything to the pressure on monetary policy, still heading toward restrictive territory, but it is going to give some breathing time to the dollar, and that's going to do just one thing: prop up the stock market. Not on a bull market, but just back up to all-time highs, just because some stocks have been destroyed in 95 or 85% drawdown. Just then 2x on these things will be barely signs of a retracement. So a whole lot of the stock market is destroyed. And I think it has been destroyed just like it was the bear market end of the world stuff. And there is some good stuff in here. Sure, there were some zombie companies and bullshit that will never ever rise again. But just don't forget what I said back then. We're in the value crisis and lots of things will rotate. Those who think as a whole, the whole market is up because everything's good, or the whole market is down because everything is shit, it's not how it works. It's all going to rotate in here, and I think the rotation is going to start sooner rather than later. That's it. Around the euro-dollar perspective, well, euro-dollar is trying to build up its higher low points. Next up is only if we get the Fed to confirm what I just said. Then in that perspective, going back to moving averages, and I think we'll finally be able to trade above. And it hasn't happened for a long time. So that will be the sign not of a bottoming structure. Like we said, we've got to reverse multiple time frames, and it's going to take a freaking long time to get the euro-dollar back on track. But until then, I think we've gone through the worst in terms of momentum. Same thing goes for USD/JPY, expanding wedge, something that I've rarely seen. We're going to align third range boundaries on the next one, so I can tell you as well, reversal is coming along the way for this thing, and it's not going to be pretty at all, because we're going to have to break down that structure, and the support is pretty damn far away. Like I said, it's not going to be bullish to bearish. All I'm saying is that the reversal is going to be brutal. The thing is that we've been trading across very, very long-term historical level. I think that was the plan all along, to just go straight line and break that resistance, trade over 90-98 types of level to send the message, yeah, Japan is a piece of shit, US dollar is so strong. But like I said, US dollar is going to lose its reserve status. It's just a matter of time, and it's already started to happen. The dominoes are falling, and when they all start fall, the dollar is not going to be as strong as it looks like. So until then, I don't think trading USD/JPY as a bullish trade is a smart option. Trading it as a reverse is not necessarily wise either. For those who trade low risk, you'd rather like to wait to get a third range boundary, probably on the daily charts, time frames or so. Until then, it's an expert stuff only. But yeah, behind closed door with experienced traders, we're already looking at reversal trades again. But for now, TLDR, not an emergency exit, okay? Just really, really be careful for experienced traders. We've got lots of things to care of when it comes to USD/JPY. Finally, those crypto stuff. So crypto has been very volatile because it's followed the whole market narrative, the CPI bullshit the other day, volatility, but we've gone right back to the medians right after in a single straight line. So once again, we've never gone there, but just to stop those who are gambling with too much leverage. The leverage is increasing. The open interest is rising like crazy in this crypto market. So once again, there are two worlds out there. There is one of gamblers who I don't know what the fuck they're doing. You can do whatever you want, of course. I'm not telling you what you should do or shouldn't do. I just say, if you want to be successful in trading in a long shot type of thing, You rather like to avoid being in the dumb side of the equation. And to me, the dumb side is really to gamble short-term stuff. It's really not what it is. Find where the low-risk strategies are, and they are definitely weekly to monthly reference timeframes as well. So in these reference charts, do you see any anomaly? No, I don't see anything. Yes, oh, of course, we've gone bullish to bearish. Like I said, this is not a bear market. This is just a huge and painful consolidation. Same old thing as Wall Street. This is a pullback. So like I said, pullbacks generally terminates when everyone is consistently behaving like the end of the world, the recession, the crash, whatever. Bear markets are this, okay? But pullbacks look like the beginning of bear markets until everyone gets proven wrong and we flash right back up to all-time high. So that's what I think we're in. I might be wrong. And like I said, I risk manage the probabilities so that if I get wrong on this stage, I'll still trade the same way next time, and probabilities are the more I trade, the more success I'll get over time. That doesn't guarantee anything for this outcome, okay? So that's really what this is all about. Don't try to be among the ones who seek truth in the market or future forecasts, but be among the ones who risk manage the probabilities of being proven wrong while still trying to make the most rational choice. To me, I trade what I see, and what I see is not a bear market. Rising moving averages? Come on, folks. It's no bear market. So it's just a very painful and rapid pullback, overlapping the previous resistance. I know these things. Wave 5 extending's next. So just be patient, settle in. We've just embraced for the worst case scenario already. These cryptos are so down the end of the world territory stuff that, yeah, we've mentioned that. Now it's just hodler stuff. No one is selling because the only guys remaining in this market have pretty much the same behavior as I do. They are spot trading, probably on self-custody wallets. They're sending a big middle finger to the trade finance who is trying to manipulate markets right now. And to be honest, I just look at them from the distance and say, good luck, folks. You're not going to get my tokens, and I'm going to be more patient than you. So in that perspective, it's really, really all about that to me. It's going patient, unleveraged, patient again. Well, time will tell. Like I said, I don't believe the bear market in cryptos. All I believe is that it may take longer than expected to get to our targets. But if you had a plan all along, you would know that this was weekly to monthly based, and you had to be patient all along. That means, well, if you traded with leverage, got stopped in the process and so on, you might have been eventually too greedy to survive the wrecking ball that markets can be if you take too much risk in them. I personally am still in. Yes, I feel depressed just like the rest of the market because I would like these prices to increase, but I also know that there's nothing I can do but to be patient. That being said, those short-term trading on cryptos, no to me. I really say just zoom out, find the low-risk strategies. They are weekly, monthly based, so look at these markets once a week, once a month. Don't try to be among those who are sucked into the short-term time frame gamblers. That being said, see you guys for next week's update. I'm not going to miss this one. See you guys later.